Hello and welcome to the AIM Research Video Podcast. I'm your host, Grant Collins, here for your fourth quarter outlook. As always, I'm here with my friend Eric Basmajian with EPV Macro. Eric, how are you?
Doing well, Grant. How are you?
Doing well. There's a lot that's happened since Q3, and at the same time, a lot of the same.
That's right.
Today, I want to highlight just similar to what we did the last time. But maybe let me kick it off, Eric, by showing you a couple of things that I'm looking at,
Sure.
and then ask you a little bit primarily on the growth side of the economy to start.
Cool.
So what I've been seeing, Eric, and I'm going to show my screen here real quickly. So what I've been seeing is a couple of things. We've seen growth and inflation just continue to slow down, and it really has been a slow-moving train on the growth side. The third quarter, in my opinion, brought some more decelerating demand. It brought a housing market recession. It brought a peak in inflation, which I really want to touch base with you on and see what you're thinking there. And really a slump in sentiment, both from business owners and from consumers, right? And so what I wanted to touch base with you on is more of this declining demand and how you're seeing it. So the first thing that I look at is like Fed survey data from Texas, Philadelphia, and New York. They're not quite recessionary, as you can see here. It looks very similar to like Brexit of like 2016.
Yep.
Not too much like 2008 or 2020. But when we look at that, and then we also look at consumer confidence, for instance, that's rebounded a little bit as maybe they've gotten a little bit of relief at the gas pump, but certainly still at very much recessionary levels, below both the 2020 and the 2008 recession, right? So outside of sentiment, we're also seeing declining demand in things like new orders, right? So new orders have come down from their peak, kind of flatlined here. But when you actually survey the business owners, they're still highlighting slower new orders. You know, that's also showing up in probably the leading indicator, like the durable goods new orders, as it dropped below trend and is starting to look a little toppish here. And we're also seeing things like backlog of orders and delivery times come down hard as they're starting to work through what's left over, since they no longer have new orders coming through. So, Eric, I want to kick it off to you. I'm seeing the economy just continue to spin its wheels and continue to slow down from all the tightening that's come through. What's different than what you and I talked about in Q3?
Sure. And as I answer that, maybe you can give me some screen share permissions here. Basically, I think you summarized it pretty well. There's been a lot of narratives that have been changing. There's been a lot that's happened in terms of UK pension was a headline, the Japanese yen's been a headline, but in terms of the economy, not all that much has changed. Some of the viewers might be familiar with the fact that I define the cyclical trend by a combination of income, consumption, production, and employment. These are the major components of the economy. We need to look at all of them because they cycle together. And if you have a full-blown recession, what you really need to see is you need to see a negative spiral where less income feeds to less consumption, less production, lower employment feeds back to lower income, and you sort of get that vicious economic spiral downwards. That's really what we're looking for when we're trying to look for a recession. And when you take those components of the economy and you put them into one composite basket, which I do here to sort of define the trend in the economy, where are we? What we see is that the growth rate in the economy has been decelerating pretty consistently since the spring of 2021 up until the last 4 months. Up until the last 4 months, we've basically trended sideways in terms of real growth. We haven't really decelerated. We haven't really accelerated. We've sort of trended sideways right on top of the long-term trend, which I'm just defining here as the 10-year average. And you see that that transition basically in asset markets as well, where the market has sort of grinded sideways since the summer. You look at any of your market ratios that are correlated to real growth, like the copper to gold ratio, high beta to low beta. If you look at any of those charts, they sort of take on a pattern where they've declined sharply from 2021 into 2022, but now they're basically hovering flat since the summer, refusing to make a new low. And I think that that'll remain the case until we see a definitive break lower of this coincident data. Just breaking it down a little bit further, a lot of people think employment is the strongest component of the economy right now, but it's actually industrial production. Industrial production is growing at a 4% annualized rate. Employment's growing at a 3.3% annualized rate. Employment and production are way stronger than income and consumption, which is a little bit unusual. If we look at income and consumption, the economy is borderline recessionary. We've had 3 consecutive months where growth is below 1% for income and consumption. So the consumer is really starting to feel the pain of higher interest rates, higher inflation. They're pulling back on their consumption. But we have production and employment that's growing at a really robust 3.5% rate. If we take the spread between these two lines, we get a chart that looks like this, and it reveals that it's pretty uncommon to see employment and production outperforming income and consumption by such a large margin. So question really is what's going on here. And I think what's going on is this phenomenon of delayed production as a result of some of the supply chain constraints. What we're seeing in terms of industrial production is a really significant outperformance of motor vehicles and aerospace. And normally when the economy is slowing, those sectors are leading the declines in industrial production. But even though the economy is slowing very hard, those segments are outperforming very strongly. So I think what's happening here is that there was production that was supposed to take place 4, 5, 6 months ago. Parts weren't available. That production got delayed. You can't lay off labor if you still have to produce things. So now the supply chains are clearing. A lot of parts are coming in for autos and aerospace. So that production is occurring now. That's boosting the industrial production numbers, and it's causing the employment numbers to remain somewhat elevated because, again, you can't purge your employment if you still have residual production. So what I think is going to happen here is as this production filters through and manufacturers get caught up, they're seeing a lack of new orders coming in, which you pointed out. So once this production sort of filters through, I think we're going to see a pretty sharp drop off in industrial production. Companies will be a little bit more willing to purge some of their excess labor, given the productivity numbers are falling. And then we will ultimately see a break lower in that aggregate coincident data, which in my view will cause the market to have another leg lower as we move towards really a recessionary pricing, which hasn't happened yet.
No, that's a great point. And I think that's why we're seeing those backlog of orders start to decelerate so hard, right?
Exactly.
Is them working through all that excess orders that they have
Mhm.
left over that they haven't touched yet.
Right.
That's a really good segue into just talking about growth broadly.
Mhm.
So I want to show you kind of my estimate going forward from here. But before I do, I think there's probably one more piece of demand destruction that we have been seeing, and you've done some great work on this. So I'd love to get your take on the housing market. The way that I see it is consumers really took advantage of the low interest rates when they were available, and now they're really taking advantage of their high prices that they had. On the left-hand side, you've seen home equity lines, and a surge in home equity lines, in my opinion, is also keeping some of this cycle going.
Mhm.
I think it's a big reason why consumption is still on trend and not sharply below trend. The other side of it is now that the mortgage rate is well north of 7%, you're starting to get a rollover in home prices as well as a spike in supply and a rollover in home sales.
Yep.
Now, you've done a lot of work here. What else are you seeing in the housing market that others might be missing?
Mm-hmm. Yeah, I think that you outlined it perfectly there. Basically, what's happening is housing moves really early in the sequence, which is why it's such a good and important indicator to track. Basically, the Fed is conducting extreme monetary tightening, which has caused interest rates across the economy to rise really rapidly, including mortgage rates. So that's sort of the first step. The second step is you see a really rapid slowdown in the volume of activity in the housing market. if you look at total home sales, which includes new and existing, the volume of transactions is down about 30% from the peak. That's historically quite consistent with pre-recessionary periods. So the volume of activity has dried up pretty significantly. You're seeing that in the home builder sentiment surveys. And what's really going on, which is the most interesting dynamic in real estate right now, is there's this widening gap between the inventory of new homes and the inventory of existing homes. I would just encourage everyone to go to my YouTube video on the housing shortage. I could just explain it much more detail in that video, but in a quick 60 seconds, what's going on is the inventory of existing homes is extremely tight because everybody in the world who had a home refinanced their mortgage at 2.5%.
Mhm.
Now the mortgage rate's 7%. Those people are totally locked. They can't sell their house because that means they're going to be trading for a 2% mortgage for a 7% mortgage. So the month supply in the existing home market is currently 3.2, which is extraordinarily tight. Anything below 5 is a tight market. But the new home market, the home builders, they're building homes. Nobody is living in those homes yet. They have to sell it to a brand new customer who has to take on a brand new mortgage. Obviously, nobody can do that with 7% rates. So the month supply for the new home market is spiking. It's at 9.5. So we have the month supply in the new home market at 9.5, very loose, price cuts. And then we have the month supply in the existing market at 3.2, extremely tight. So the question is, well, are home prices going to really fall because the existing market is too tight? Is the new home market going to drive prices down? My personal opinion is that home builders are the price setters. They're going to act like any other industry. They're only going to hold inventory on their books for so long. And then eventually they're going to mark down the price, take the loss, and move on.
Right.
So I think that we're going to see so as you noted in your chart, the month supply of new homes rising very rapidly. That's going to continue because the mortgage rates are continuing to creep up here. So home builders are going to be severely under pressure. They're going to start to reduce their prices. They already have. And just due to the comparison effect, I think that's going to mark down the price of existing homes, even though the inventory is staying very tight there. So I think what the biggest thing people are missing in the real estate market is they're looking at the total inventory, which is skewed by existing homes, and they're saying the inventory is still very tight, therefore home prices won't fall. I think it's a little bit of a different dynamic this time. Admittedly, though, we've never seen this environment, so nobody has a clear idea of where it's going. But I don't think that the gap in inventory between new and existing homes is favorable.
Yeah, and not to mention, you and I at our third quarter talked about the Fed the last time, and of course, Jerome Powell came out and said that they still have some ways to go here. If we're already seeing some very hard reduction in housing sales and basically throwing the housing market into a recession, and yet he still has more time, more further rate hikes to go, then you'd have to assume that housing is just going to be non-existent to GDP going forward from here.
Right. And there's only so long that the economy can handle housing not being a positive contributor to economic activity.
Mhm.
Once housing becomes a detractor from economic activity, you basically start the clock until recession. It's so incredibly cyclical, and it's such a high multiplier sector that if volumes in the housing market decline by 30% for a month or two, you can maybe handle that. But as you mentioned, if the Fed's going to keep tightening for another quarter or two, and volumes in the housing market are going to decline 30% and stay down for 6-8 months, which looks like the likely case here, it's super negative for all of the industries that the housing market feeds, such as retail sales, furniture sales, all of your major durable goods sales, which is going to have a natural hangover from the pandemic stimulus anyway.
Yeah, it's a big.
So you're looking at a very large and perhaps a protracted slowdown in your small but high multiplier sectors of the economy, like housing and goods.
Well, and it's leading the OECD leading economic indicators, right?
Mhm.
Because housing starts building permits are in there, right?
Yep,
Durable
exactly.
goods are inside of there. And it's the black line that you're seeing on the chart here. As I mentioned in Q3, it was already going through the
Yep,
floor of growth. It's going further through the floor. And even though we've landed on trend, it's pretty likely that housing is going to drag the economy into
exactly.
recession because
Yeah.
it's just feeding over into everything else, right?
Exactly, exactly. It really does feed into every industry. So there's really only so long that you can have a very deep, protracted slowdown in the volume of activity. Again, it's a super important point. Everyone always thinks about real estate as a price cycle. Well, prices aren't going down. There's two cycles in real estate. There's a volume cycle and a price cycle. Just like the economy, there's growth and there's inflation. Um, Growth is tied to volume. Volume has collapsed. There's no really debate about that. The question is, how far will prices decline? Um, we're starting to see prices roll over now. It's normal that prices lag volume, but I have a hard time seeing how the economy is going to avoid a recession and home prices aren't going to fall. Some degree of seriousness, given how deep the slowdown in the housing market has been so far, and how long it's likely to stay depressed, given how long the Fed is going to remain on the brakes here.
Yeah, and I would also echo that then I would begin to see these home equity revolving lines start to really roll over hard.
Yeah.
And all of I have two bank presidents that we talk with on a regular basis, and both of them have echoed that their business has been strong this year, but it's only because of home equity lines.
Mhm.
So as we start to see people kind of back off, because their home price is evaporating in front of them, right? And the mortgage interest rate has gone through the roof, then you're going to start to see, that kind of filter the rest of the way through,
Yeah. Yeah,
right?
the last point I'll make before we go to our next topic here is that there's really good academic research on the wealth effect. And
Mhm.
the research suggests that the wealth effect from stocks is virtually non-existent, right? Stocks are way too volatile. Nobody borrows against their stock portfolio, or very few people do. And you had an absolutely booming stock market for 10 or 15 years, and consumption growth was 2% or lower. Um, the wealth effect for the housing market is much stronger, however, because of the effect that you just described, with people who are much more willing to borrow against the value of their house. So if their home goes up by 30 or 40%, they'd be much more willing to borrow against their home to consume versus borrow against their stock portfolio to consume.
Right.
Right now, stocks and bonds and liquid financial assets are down 20 to 30% across the board. But the mark on the housing market right now is still relatively close to peak. You know, even though home prices in actuality may be down 15% if you tried to sell it today, nobody's really in their mind marked down the value of their house yet, because we haven't seen that occur on a broad scale yet. So, the negative wealth effect hasn't fully set in yet, because if you surveyed people on the street, they don't think the value of their home is any less, even though it probably will be either now or in the not too distant future.
Yeah, it's a big reason why I think you're still seeing people tack those home equity lines, and why we're seeing the cycle, at least from the consumption side, not rolling over harder. That's at least my viewpoint, is once we see this like home equity line stall out, since the savings rate's so low and since incomes are so low, right? That's when I think consumption really does start to slow down. And I think we're getting there, right?
Yeah.
And this is exactly what Jerome Powell wants, right? He has said it at Jackson Hole. He said it again in September. And then he didn't really mention it as point blank in his most recent November meeting, but he wants the economy to grow below trend for some time.
Mhm.
Right now, we don't know how long for some time is necessary or how much it is restrictive. But if you just think about it intuitively, if you get aggregate demand lower, you're going to create a recessionary gap that's going to drag this inflation rate lower.
Yeah.
right? And so this is where all of this tightening from the Fed's coming from, is they only have one tool that they can really wreck, and it's the aggregate demand of the economy. And they're doing a really good job. And I think we're still in the very early signs of it. So, Eric, let's move to the second phase of this diagram. Let's move to inflation, right?
Mhm.
I think it's peaked. And there's a couple things that I want to show you here that make me think that. Although it's peaked, I do want to add a caveat. I still think it's stubborn on the way down, and it's going to be very difficult to get to 2, unless the recession is much larger than I'm expecting. So one of the things that I'm seeing here is just the PPI and the input prices. Now that we're starting to see that backlog of orders come through, the slowdown in new orders, and those delivery times slowing down, we're really getting a hard reduction in input prices,
Mhm.
which hopefully should feed through to us as consumers at some point. The other thing I'm seeing is one of the key drivers of inflation from the very beginning was gasoline prices and energy prices. Those have been consistently rolling over, and they have a new floor thanks to the Strategic Petroleum Reserve and Biden. He says he's going to buy at 67 to 72, I believe. So that changes the price a little bit, although shelter, food, and even supplies of a medical care services accelerated a little bit.
Mhm.
The other thing that I've been looking at, Eric, is just liquidity in general. We've seen the money supply start to drop below trend extremely hard as they've pulled money from the system. And if
Mhm.
you look at year over year percent change, and you look at just the trend of money growth, that has not only peaked, but has rolled over extremely hard,
Mhm.
which I think could be another catalyst for inflation going lower. Um, so let me ask, Eric, is there anything in the inflation components that you're seeing differently, or that make you believe that it's going to stick around longer or move higher or accelerate to the upside from here? Because Jerome Powell was he was very clear, which I was surprised. He said that he didn't see any signs of it slowing down, and I'm like, wait a minute, I definitely see signs of it slowing down.
Right. Yeah. Yeah. If you could flip the screen share back over to me, I view inflation as a money price wage spiral. I think we may have talked about this on our last call, but inflation is really misunderstood. A lot of people define it as a wage price spiral. They say if wages are high, that's going to become entrenched and that's going to feed on higher prices. It's really not how it works. The sequence is really a money price wage spiral. So you get a monetary acceleration, then prices in the economy start to rise, and then employees go to their employers and say prices are rising, I need a increase in my wage to basically maintain my standard of living. And in a perfect world, they get a raise slightly above the rate of inflation, which feeds back to an endogenous increase in money growth through an increase in consumer demand and bank lending. And that spiral is able to continue, and you get a money price wage spiral. It also works in reverse, though, where if the Fed decelerates monetary policy or has a contractionary monetary policy, prices in the economy start to come down. And if that is sustained long enough, eventually wages or employment start to come down. So what I see going on right now is the first part of this process, money is significantly contracting. So the Fed is engineering a very, very significant monetary deceleration. Doesn't really matter what monetary aggregate you look at. You could look at M2, you could look at deposits, you could look at monetary base. Any monetary aggregate you want to use is contracting at a near record pace.
Hmm.
So the first part of the process, money significantly decelerating. And then if we just look at prices throughout the economy, anecdotally, we see used car prices coming down. We see trucking rates coming down. We see the container rates normalizing back to their pre-COVID levels. And if we look at more reliable leading indicators, we see the price of industrial commodities is falling at a 22% annualized rate. And even if we look at broad commodities, which includes oil and food, it was rising at a 100% annualized rate after Ukraine. It's stuck around this 60% annualized level, and it's fallen, basically hovering at zero or negative. So we have a negative monetary deceleration. Prices in the economy are starting to fall. Stock prices, asset prices, home prices, container prices, used car prices. I mean, anything you look at anecdotally, it's starting to come down. this has been confirmed by our sentiment surveys. Small business expected selling prices starting to come down now. You showed this. This isn't updated as of today, but manufacturing prices paid coming down, actually fell below 50 in the last report. So money decelerating, prices are falling. Now, the process simply needs to be sustained long enough for it to filter through to wages. I think one of the mistakes that the Fed may be making here is that this negative money price wage spiral, in my view, all it needs to do is for it to be sustained. They don't need additional muscle. And I think that they keep mistaking the fact that inflation isn't coming down for the fact that they need more intensity or a higher terminal rate, when if they raise the Fed funds rate from, if they raised the Fed funds rate 500 basis points yesterday, it wouldn't impact the next CPI report that we get. It wouldn't even impact the CPI report after that, right? So it's not that they need to intensify this process. They just need to be highly reluctant to stimulate and go the other way. And then I think in time, this negative money price wage spiral would filter all the way through to wages. So where I see inflation now is it's a process. It's a money price wage spiral. There's a significant monetary deceleration underway. Prices throughout the whole economy are starting to fall. Now it's just a matter of time, in my view, a matter of months before the labor market starts to significantly soften, and then you're going to get a deceleration in wages. The Fed has to be super, super, super careful not to re-engineer an acceleration in money before the wages come down. Otherwise, you'd reignite that money price wage spiral going in the upwards direction while the wage rate is going to rise from an elevated level. So they basically just need to sustain this monetary contraction. In my view, they don't need to intensify it for a long enough period of time for it to filter from money to prices to wages. And I think that they'll have made sufficient progress by the end of the first quarter in this regard. But I think in hindsight, when we're going to look back and say they moved too far in terms of the magnitude in rates, and really was appropriate was a more sustained pace.
Yeah, and I think that's where "for some time" comes from, right? I think that's why he keeps using it in his language.
Exactly.
And I think that's the most important part of his language, right? It's not the rate hikes. It's not the balance sheet rolling off in the background. It's restrictive stance.
And I think what he really tried to do in the press conference yesterday was he tried to puff out the belly of the curve without increasing the terminal rate. Because he's trying to break the cycle of every time the CPI comes in hotter than expected, we increase the terminal rate from 450 to 475 to 5. And he's basically tried to signal to the markets and say, look, I don't want you to increase the terminal rate much further, but I do want you to puff out or effectively remove the cuts that you have. Right. So the terminal rate, as I looked before this call, it was 5.06 before the Fed meeting. It's about 5.1 right now. So he successfully got some tightening into the market without increasing the terminal rate pricing all that much. What really got hit today, and we're recording this the day after, the belly of the curve. 2s, 3s, and 5s, last I looked, were up 10 to 15 basis points.
Yeah, 470 on the 2, I think.
Yeah, so the terminal rate didn't rise, but he puffed out the belly of the curve, which is, I may not go all that much higher, but I'm going to stay here for longer.
Yeah. Yeah. No, I think that's spot on. That's kind of what I've been thinking. Primarily, one, because we've started to see this third plateau of the 2-year. One of the things we haven't seen yet is that plateauing of the 1 month, but that usually plateaus when the Fed plateaus, right?
Yeah.
So I do want to ask, before we move into the interest rate conversation too deep, when you were mentioning wages there, does contracts and the stickiness of wages and the way that like Keynes talked about it, does that play a part in your framework or your thinking of your money price wage spiral?
Yeah,
Because
well,
if you think about it, people are getting these pay raises and maybe their salary and they're getting it for the whole next calendar year, which is why I think that it's going to be difficult to get back to 2 unless the recession is much sharper than most people are thinking.
That's why it's just last in the that's why it's last in the sequence, right? You
Okay.
basically just need the money, monetary policy to be decelerating for long enough, for prices to fall long enough, where it's not a matter of your contract. It doesn't matter if your contract expires in a year if you get fired tomorrow,
Right.
right? So the
Right.
wages are going to come down. Everyone has this idea that wages come down because employers go to their employees and say, we need to pay you less. They come down because people get laid off,
Right.
right? That's really why they come down. So it's why the wages are a lagging indicator, is my answer to the point that you mentioned about the contracts and how they roll off. I totally agree, and that's why it moves last. So I think ultimately what happens here is monetary policy decelerates, prices fall, margins get compressed, profits fall, and eventually, if that process is sustained long enough and there's no light at the end of the tunnel, employers reduce headcount pretty aggressively, and that's the factor that pushes down wage growth.
Yeah, no, I think that makes sense, and it echoes what I think Jerome Powell's wanting to do, which is break the employment side of the economy.
Yeah.
He's trying to do it to the best of his ability without hurting millions of Americans, right?
Right.
I think it's going to be a little bit harder since we've had this shift in supply. You and I and everyone is going to look at the labor force participation rate tomorrow as it comes out, and it's still at roughly 62.3, I
Yeah.
think is what it currently is. We've had this weird dynamic in the supply and demand of labor where we've had this dramatic shift outward for demand as everybody was returning to work post-COVID, but then you also had a shift in as supply also got hit at the same time, which is where a lot of these wage pressures have come from to begin with.
Right.
Right. It's just the fact that wages are kind of in the hands of the worker this time rather than in the hands of the employer because of just that low labor force participation rate. So I think he's trying to, tackle two things, right? He's trying to get, the job openings lower, trying to get the quits rate lower, while at the same time trying to restrict the economy enough to where those wages start to come down.
Yeah, I'll answer the question with one chart if you flip it back to me.
Yeah.
I think you can boil down the labor market to one metric if you had to, which in my view is the employment population ratio. The employment population ratio, I think, is the best overall reading on the labor market. And what you can see, which is interesting, is that employment to population ratio is increasing throughout 2021, and it's basically held flat since March of 2022. Since March of 2022, we've had an increase and then a complete flattening of the employment to population ratio. This is also the same time that initial jobless claims bottomed. There is a cluster of employment indicators that sort of pivoted around that March, April time. Another indication would be full-time employees. Full-time employees have declined in 4 of the last 5 months. So there's some evidence brewing, based on the way I look at it, that there's some shift in the labor market that's going on. And the reason that this is so important to me is if you look at the rate of change in the employment population ratio. So what I'm graphing here is the employment population ratio, the current level as a spread to the 2-year average. And that's the single indicator that I found to be the best leading indicator of overall wages. So essentially what Powell needs to do is he needs to get this employment population ratio down. If he gets the employment population ratio down, then ultimately wages will follow with a lag. We've started to see some change. Well, this will be I'll be looking at in the next report. If we see a tick up, do we see it start to roll over, move lower? The reason, in my view, that every single recession lowers inflation, and this upcoming recession will be no exception if that ultimately is our path, is because 100% of the time in a recession, the employment population ratio falls. And falls pretty significantly, right? 2 or 3 percentage points. So that would be, this going from 60 to 58. And that causes these very sharp declines in the rate of change in employment population. And that really causes a big shift in wages. So I like to look at the employment population That's the number that Powell's got to get down if he wants to slow wage growth. And really just the rate of acceleration in this ratio. So
Yeah. So
I think
it's
he's
so
on track, just going to take a little bit more time.
it's so funny how we can look at different metrics but arrive at very similar outlooks. So I look at something a little different to see the employment cycle that you're seeing there. Let me get back over here. So I look at just the total civilian labor force and then total non-farm payrolls plus job openings, because that would be the quote unquote demand of the economy for labor, and this would be the quote unquote supply of the economy. So very similar to your chart, we would need to see these jaws widen to
Mm-hmm.
where that demand really
Yeah.
starts to divide off. And if you
Right.
do
Right.
that, you start to get a spike in that spread and you get to get a fall down in wages then at that point.
Right. Right.
Right. And to your point,
Very
survey
interesting.
data from Philadelphia, New York, and Texas, both current and future employment indexes are starting to roll over,
Mm-hmm.
despite the fact that you're getting a flatlining in non-farm payrolls.
Right. Right. Right.
Right.
Yeah,
So
very much on the same page. That's a great chart, the supply of labor versus demand of labor.
I think that's, I've been trying to find some way because we've kept hearing that it's tight, it's tight, it's tight. And I completely agree. Especially, I think this visually sees it because you can see, that it's never been this tight in the last couple of recessions. But what makes this one so much different is just the supply and demand dynamics, that you really did truly
Right.
have the supply drop off of a cliff. And the labor force participation, or the civilian labor force, I think shows it extremely well that we just haven't fully recovered and we've not moved these people back into the workforce just yet.
Right. Right. Right.
Right. So, Eric, I think that brings us to maybe our final conclusion on the market, right? So, we've got an economy that's now on trend. We've got demand destruction in the housing market, in new orders. We've got the Fed set to continue tightening. Before I get your comments there, I think I want to re-echo just real quickly. It sounds like you think the Fed's going to go too far when they really should pause. I want to re-echo that first. Is that right?
Yeah, I think that's right. And I don't want everyone to think that I'm sympathetic to the Fed easing policy. I don't think that's the right choice here either. I think the Fed probably already has gone too far in expectations in terms of 5% has basically priced into the market. I think that's too far, and I think the appropriate policy would have been a lower terminal rate, but more sustained balance sheet reduction and holding at the elevated level for a longer period of time. So I do think that the Fed is in the process here of significantly over tightening, and that's going to be problematic for the economy in relatively short order here by the first quarter, I think, and then inflation in mid and late 23.
Yeah. And so do you also include the balance sheet runoff in that too? There's a lot of research that says, depending on the size of the balance sheet runoff, you can tack on another like 0.25% rate hike if the balance sheet runoff is large enough.
Yeah, I do. I take them both together. I think that it would have been more appropriate for them to peak in the terminal rate sooner than they have, hold the terminal rate at that level. In other words, be extraordinarily reluctant to cut rates under any conditions, unless it was completely emergency,
Mhm.
and unwind the balance sheet for several quarters until they neutralize the excess liquidity in the market. I think that would have been the more appropriate path. I think the path that they're on now, they've gotten the terminal rate to a pretty significant level here. As a result, mortgage rates have spiked, and I think they're going to do more damage to the housing market than they originally intended. And given the leading nature of the housing market, I think it's going to make the broader economic mess a lot more difficult to clean up when that time comes, maybe mid 23.
Yeah, and I don't think they need to go much further than they have, but Jerome Powell's really obsessed with getting real rates positive. And when we look at the real Fed funds rate, it's still extremely negative.
Mm-hmm.
When you're looking at like the PCE, which is more favorable to,
Right,
to where they are right now in the cycle,
right, right.
right? So with all that in mind, demand destruction and continued tightening, uh, what are you thinking on the market? So it's moving
Yeah.
sideways now. I think you echoed it a little bit, but I want you to unpack it
Mhm.
further. More downside to come.
Yeah, I think that basically what you've had is you've had a little bit of a pause in some of the downside, whether it's the actual market like the S&P, or whether it's any relative performance ratio, copper to gold, high beta to low beta, momentum to low volatility, any sort of proxy for economic activity has sort of stabilized over the last 4 months. I think that stabilization gives way to further downside, whether it's the broad market or any of those internal ratios, because I think that the economy decelerates pretty strongly over the next 3 to 4 months here. And what I'm using to make that determination is the fact that monetary policy continues to get increasingly restrictive. The downturn in the housing market is gaining momentum, and the yield curve is deeply, deeply inverted. Um, when you see really sharp declines in monetary aggregates, a decline in the housing market, and a very deep yield curve inversion, that's very strong evidence that monetary restraint is fully entrenched. And that means to me that over the next couple of quarters, that monetary restraint is going to ultimately hit coincident data like employment, broader consumption, and production. And that's
Yeah.
going to, reduce profits and bring the market, in my view, to a new low.
It's something that I don't think many people are echoing, but the earnings recession is what's coming next,
Yeah,
right?
exactly. Exactly.
And I think we've seen it with a couple companies actually reporting, but I think it's going to continue to manifest as they
Right.
continue going through the rest of this year. It has been interesting to see the market rally from the summer lows and kind of move and trend sideways, because when we look at this risk reward plot that I've shown in previous videos, almost everything besides international is trading in a more favorable way.
Yep.
Right. Everything has just taken a broad step higher. You're getting both risk and return over
Mhm.
the last quarter. And I think, unfortunately, that's going to wind down as well. Anytime,
Yeah.
and I've mentioned this, but anytime you have growth decelerating, you have to be looking at things that take below average risk but give you above average return. And it hasn't changed. It's still your dividend payers, it's still your defensive, it's still your value, even with this acceleration that we had since the summertime, right?
Yep.
Um,
Exactly.
Even on the sector side, healthcare, financials creeped in there a little bit. Staples kind of fell below, and utilities fell below, and those are kind of your bellwethers. I think people abandoned those for the energy, the discretionaries, and the
Yeah,
tech
yeah,
that got hammered. And I think that was
yeah.
probably the wrong play. But this is how the market rotated. They
Yeah, and
really,
and look, it wasn't a inaccurate or inconsistent rotation given the stabilization that did in fact materialize over the last 4 months. I'm not a short-term player. I don't think you're a short-term player. So, 3 months to me is not something that I would shift my outlook for. Although we did empirically have a stabilization and growth for the last 4 months, the market did in fact respond to that. And that's all well and good. But staying focused on the 6 to 8 month view at a minimum, which I think you do as well, I have to assume that the stabilization that we saw in growth is going to break down, ultimately making new lows and ultimately printing recessionary growth at the end of Q4, Q1 time period is where I think we start to see much sharper fall offs in the coincident data, which the market I think will then price in as well.
yeah, I think they got too short term, right? There's a big difference of falling to trend or growing on trend. What we've just did is we fell to trend.
Right.
And I think that's probably the big difference there.
Yeah.
Uh, Eric, I think we've hit all the main points that I wanted to cover today. I think we've got a pretty clear synopsis that the excess tightening that's now going to come through the pipeline here by the Fed, because I think you and I both agree they're already in restrictive territory, and
Oh
now
yeah.
they're going beyond that now.
Oh yeah.
Um, is there anything else that you want to add that we didn't get to cover today?
No, I think that was a pretty good recap. Like we mentioned, a lot has changed, but not a lot has changed. So it's moving at a snail's pace here, but directionally, we're still inching closer and closer. I think to that recession that we've been talking about for a couple of quarters here. But it's moving closer and closer with each passing month. Just not quite here yet.
So as the recession kind of fully sets in and we finally get that last leg, um, when as many people would probably ask, when would you believe that the market would begin to somewhat bottom and then start to
Yeah.
reaccelerate again?
I would just need to see a reversal of that whole sequence that I outlined as I go from my leading indicators to my coincidence. So to me, what marks the bottom of the market would be basically a very strong degree of confidence that the cycle has bottomed and we're going to begin accelerating. So what I would need to see for that would ultimately be, the Fed cutting interest rates, stimulating monetary policy that feeds through to a stabilization and then increase in housing activity. And then at that point, and then a steepening of the yield curve. And at that point, you have pretty strong evidence that the broader economy will accelerate in the months ahead, and the market would start to price that in a couple months before it happens.
Yeah. Yeah. And to give listeners maybe one more indicator as far as what I'm looking at, I mentioned it in Q3. I'm going to re echo it again here. My signal is when the economy officially goes through the floor of
Mhm.
autonomous level of investment. It's something that I spent a lot of time on and talked about in our third quarter video, but that's typically where investments start to get made for the economy. And I think that will be my signal on when we begin to maybe start to re-enter or relook at jumping into a more risky environment or
Yeah,
more risk type investments there. So
definitely.
Eric, as always, I greatly appreciate your time on these. It was a great update. Just to re-echo, how can people get a hold of you? How can people find you and your work?
Yeah, thank you. No, I love these. Easiest way is on Twitter at EPB Research, or go over to my website, epbresearch.com. I have a free framework video that you could watch, 10 minutes long, kind of takes you through the economic sequence that I just outlined. Yeah, those are the two best places, epbresearch.com and then Twitter at EPB Research.
Awesome. He's Eric. I'm Grant. Thank you all so much for listening. We'll be back again next quarter to bring you another update.
Thanks, Grant.
Thanks, Eric.